from one balance sheet to the next and the income statement in between. In this lesson, we shall study an accounting cycle which is not the first one of the firm. We shall begin the cycle with a balance sheet already containing entries from the year before and with an empty income statement, of course. So let's take a look at the firm at the beginning of the cycle. By this, we take a look at its balance sheet. It has an asset side and a liability side. So we see that this firm begins the year with machinery, a van. They have been already amortized. It has inventory at the beginning of the year, closing stocks of the year before of 600. It has some client IOUs. They have been provisioned for 500. There is some money in the bank, some money in cash, and some prepayment, that is charges of last year, which actually concern this year and therefore are temporarily assets. On the liability side, we have a capital of 8,000. The cumulated past profit or loss is a loss of 750. This firm has a debt of 2,000, a costly debt, and it has also debt to suppliers, but to the van it owes, to the supplier of van it owes nothing. To the supplier of machinery, it still owes 500. To the supplier of goods, which are temporarily in stocks or have been sold, whatever, it owes 500. And there are some accruals of 50, that is charges of last year that have not been paid yet, and we haven't even received the invoice yet. We may also observe that this total debit minus the credit on the asset side is 10,300. And the total credit minus total debit on the liability side is also 10,300. Therefore, this balance sheet is properly balanced as it should be. In order to understand even better the situation of the firm at the beginning of the year, we may take a look at the income statement of the year before. And this is the income statement of the year before. It had sales of 7,000. For purchases of 3,000, but closing stocks that we just saw of 600. So the cost of goods sold was 2,400 and the gross margin this figure. And this firm paid rent for 800, shop expenses for 1,200, salaries, and it had some amortization of the year and a provision for bad clients. We shall work in this cycle now with the following journal. It has 14 entries. Once again, we do not purport to illustrate good management nor very realistic accounts, but we shall show how the mechanics of accounting works. So we have this journal which begins with a purchase of more goods because we have very few left. The firm will pay rent, will pay shop expenses, etc., up to interest charges on the loan of 2,000. And we have here monitoring of the ongoing stock using the FIFO method. So the accounts at the beginning of the cycle can be presented in some sort of a beginning balance, if we like. This is just the list of all the accounts. The income statement accounts, of course, are empty. Interest charges empty, purchases empty, rent empty, salaries, etc. But the balance sheet accounts have the balances from the year before, that is from the balance sheet we just saw. And the adjustments for the year are also empty. So let's begin to record the transactions that are in the journal. And you are strongly advised to do that for the entire journal. Well, first of all, we record the purchases of goods on credit. So the purchases account receives 3,000. That's the first entry in the journal. And the supplier of goods, which already had a figure from last year of 500, is credited 3,000. The rent we pay by check 1,000 and the bank already had 1,000 in debit, that is in reserves at the bank. So thank God we do have exactly the money to pay the rent. And now currently the balance of the bank account is 0. Remember that if we have agreements with our banker, we may possibly go in credit at the bank account, but it's unusual for a firm that begins, or even after 1 year. Shop expenses. We pay shop expenses we consume shop expenses of 300, but these were taken care of by the prepayments that are in the assets. So the prepayment is credited 300, and now this will sort of disappear from the balance sheet. In other words, this consumption of shop expenses is recorded during this cycle, but was already paid in the last cycle. Then we pay the accrued charges of last year with cash. Cash begins with 500, so it's credited 50, and the accruals, which recorded 50 due to some suppliers, now are debited 50 and will disappear temporarily from the accounts. Then we record a sale of 4,000 in cash. The sale is always in credit, and the cash account, which has already these figures, this from last year and this because we just made a payment, now is debited 4,000, etc. So once again, you are strongly advised to do this recording the standard way for all the transactions of the going cycle. When this is done, we reach the following trial balance at the end of the posting of all the transactions. But we still have to do the adjustments of the year. So these are all the figures, that is the balances of all the accounts after all the posting, and there remains to be done the adjustment of the year. So we make the following adjustments for stocks. Ending stock, we saw them 720, 720. That's in credit in the EIS. It will correct the purchases and opening stocks. Then adjustment for amortization of the year, another 1,100, 1,100, you remember, in the EIS and in the BS. And we have something special. Since the client we had provision actually paid, we have to recover the provision, and this is done via this recovery of provision income statement. It will become a credit, and recovery of provision in the balance sheet, it will be a debit that will cancel this past provision. Then we extract all the revenue accounts from this trial balance, and this is the income statement of the year. Sales of 10,600, opening stocks that we saw 600, closing stocks 720, and the purchases of this cycle 3,000. This enables us to compute a COGS. A gross margin of 7,720, and the various charges of the year: rent, shop expenses, salaries, interest charges on the loan, and the two yearly adjustment that we just made. And I made no more. I decided that there was no more provision for bad clients, no prepayments, and no accruals in there. So as you remember, we shall replace in the trial balance all the revenue accounts by the net profit of the year that will be added to the net profit or loss of the past years. And this finally leads us to the balance sheet at the end of the year. This is the balance sheet of the end of the year now. Assets and liabilities. Machinery, gross value 5,000 as before. Van, 3,000 as before. Cumulated amortization, now it's 2,200. Stocks, these are the closing stocks. Client, you go back to the trial balance to see. No more provision. At the bank, we have much more money. No more prepayment. on the liabilities, the capital didn't change. Now the cumulated net profit is a figure in credit, that is a profit. Long-term loan, we have not yet begun to amortize it, that is to pay it back. And we have these suppliers and no more accruals.